Hi everyone and welcome to another episode of the DollarsAndSense Podcast, recorded live at the MooFest 2025. I'm your host Timothy, and today we're diving into a topic that many of us would have heard about but may not always understand it well. Warrants versus options. Which derivatives should you choose? With markets staying volatile and many investors wary of long-term exposure, derivatives like warrants and options are getting more attention. But what exactly are they, and more importantly, how can investors use them smartly? To help us break this down, I'm joined by Binni Ong, a professional trader with over 15 years of experience. Binni is also a trainer with the SGX Academy. Binni, welcome to the show.
Hello Timothy, how are you?
Good. Thanks for joining us. And Binni, maybe just to introduce yourself, how do you get started on trading in the first place?
I was still counting how many years. I think it's like 30 years.
30 years also, it's not 15, but 30 years of trading. How do you get started? You must have been super... Could you even trade legally then?
I was 18 when I first started. I was using a CRT TV. You know the CRT TV and teletext?
Yes, teletext I do.
Teletext, right?
Yep.
And that was when I was in the university. So we still don't have computer. So every time I need to know the prices, I have to go to the library to get teletext. So that's how I started.
And when you started trading back then, was it just your regular stocks that you were trading?
I traded because my mom was trading. So she doesn't know how to assess the prices. So that's why we were doing this special instrument, which is Malaysia Clock.
Oh yes.
Clock, right? Remember?
Yes.
It's OTC products. And it's a vast difference from what I'm doing right now. So I'm doing a lot of automated algorithm trading right now. So back then I was doing CRT, TV, and teletext.
Okay.
That's the huge difference.
And back then, can I just ask, were there products such as derivatives actually available on the teletext?
No, only stocks.
Only
Singapore
stocks.
stocks that we have access. Not even Hong Kong, not even US stocks. Only Singapore stocks, and of course, we trade the Malaysian market.
Can you just explain to us in a very simple way what derivatives really means?
Okay, for derivative, it's a financial product that's being derived from underlying, such as, for example, DBS stocks or an index. In other words, derivative means that it's likely to be a leveraged product, likely to be offered as a fractional price, and likely to be able to let you take position in either a buy or sell, long or short, in other words.
One question I always have is warrants and options, because they look like quite similar products. They are both derivatives. So what are some differences between them?
Okay, so first, let me just give an introduction. Actually, warrants is just like options or part of an options. So they have similarities. One would be, for example, it's leverage. Both are leverage. It means you need a fraction of the price to take a position of the underlying. Number two is that they are geared returns, meaning that they move more than underlying. Number three, of course, you can use it to hedge, because both the options and the warrants, we have two directions. If you are thinking that potentially the underlying might be moving up, then you would buy a call option, or you buy a call warrant. If you think that underlying is going down, then you buy a put option or you buy a put warrant. So two directions, call and put. But within itself, there are differences. I think one of the key difference is that warrants is a lot more cheaper than majority offerings of the price of the options.
Okay.
So for example, if you look at the price of warrants, they are generally less than 20 cents. Some are priced, let's say, a few cents. For example, I remember there was once that NASDAQ recently had a huge drop, and it went to about 18,000. So I was trading one of the warrants, and the warrants was about 1.4 cents. That means 1.4 cents, yeah,
And
Singapore
this is
dollar.
for a exposure. Is there an exposure or like
The minimum unit that you need to buy for warrants is 100 units.
Okay.
Essentially, it means that if you buy 100 units for 1.4 cents, that would be how much?
140?
140, yes. But an option for, let's say, for the Qs, it can be, if you want to trade somewhere that's at the money or slightly out of the money, it can be $5, depending on where you do the expiry. It can be even, let's say, $10 per one unit, right? That means that per 100 units, which is one contract, then you probably need a sum of 1,000 USD, something like that. Or if you buy a shares, let's say you buy the Qs, it could be like you need to buy only 1.7 shares if you are buying the Qs with, let's say, 1,000 USD. So for the key difference between warrants options is that warrants can be priced a lot more cheaper. Okay, and of course that for warrants, it's by an issuer, market issuer, but they are both listed in the exchange.
Okay.
Okay, but the options is different. They are by the exchange, but warrants is by an issuer. And lastly, for the options, you are traded on a margin, but warrants is a full cash outlay.
Okay.
So that's the main difference. Of course, if you ask me from the trader point of view, then if you are looking to be exposed to Singapore listed stocks like DBS, UOB, then the only options, or rather the only alternative, it's only to use a warrant. Yeah.
Which also is cheaper as well. You talk about warrant needing an issuer. What does the issuer actually do?
The issuer will issue the warrants and list that in the exchange.
Okay.
But behind that, the issuer will also be appointing an issuer market maker that is to provide the bid and ask price. That means that anybody who wants to buy would have the warrants to buy, and anyone who owns the warrants will be able to sell the warrants.
So there's that liquidity that's provided for
Yes,
any
correct.
traders who are trading warrants.
But options is different. Options is where it's a transaction between the buyer and seller.
Right.
So essentially, there must be a buyer and seller there, and the exchange doesn't provide that liquidity.
The markets have been really volatile in 2025 due to a lot of political and macroeconomic reasons. How is warrants actually relevant in such an environment?
First, I think that volatility is something to stay. Personally, in my instruments that I'm using, warrants is top of the mind.
Right.
For example, in this year, April, we have Trump triggered, tariff triggered drop. And we saw that, for example, the HSI Hang Seng Index or the NASDAQ moved down. So it's relevant, number one, because if you do want to take short-term opportunity, for example, you think that the decline is to continue, then yes, you could use the warrant, which is to buy a put warrant to tap into where the prices are dropping. So I was talking about STI, it dropped from 3,008 at that point of time before the Trump tariff, and it went all the way to 3,004 in just 4 days. A lot of people were scared at that point of time. So if you were to buy into, let's say, the STI, they might think that it might continue to drop. So there's always a fear. But warrants has one unique characteristic, which is the limited loss. Why do I say limited loss? Your maximum loss would be the loss of the amount of money that you place to buy the warrant. Let's say, for example, if you buy that warrant, the put warrant, to think that the market will continue to drop, and you spend $1,000, the maximum loss would be $1,000, and you're not going to lose beyond that. And there won't be any margin call. Rather than to say that I'm scared of volatility, so one way to do that is to use warrant to trade on the downside or on the upside. Let's say, for example, if you think that it is going to move up and you think that the Trump tariff is not a big deal, which anyway the market recovered. So if one is to buy, rather than give up the opportunity, they could just spend that minimum amount to tap into the opportunity using warrant. So that's one thing. And it's a very good instrument for actually long-term investors. Because for myself, I own DBS stocks. At that point of time, DBS was at 46, high of 46. So when it was 43, I thought that, technically it wasn't looking very well. But I didn't want to give up DBS stocks because I was in for that long term for the dividend. So what I did was to buy a warrant to tap into the downward movement. And DBS indeed right, went to $38. So I didn't sell my DBS stocks, but in fact I was able to hedge the position. So in other words, the volatility, I think it's quite something useful if we are using instruments like warrants or options. Recently, have you know of this like blind box pop Mart? Are you into it?
Pop Mart, yes, I see some when I was in Hong Kong or Shenzhen recently,
Yeah.
and it was super popular.
Correct.
Yeah.
I was in Malaysia doing a session, a conference, and I was in Thailand as well, Bangkok. And there was actually queuing to enter the Pop Mart
store, right?
Yes.
Yeah.
When you look at the volatility of Pop Mart, it was trading at about just a high of 280 Hong Kong dollar. And in just a few days, it went down to 230. So that's volatility. But that could be used as a short-term instrument to trade in the pop market. If you think that this is an opportunity, So, but a lot of people fear, because a lot of people thought that pop market was at $20 and it just went up like $280. They didn't dare to buy the stocks itself. But if you think that there's opportunity and you are looking at short-term opportunity, you could just use a warrant to do that.
Right.
Yeah, to do pop market.
I actually like how you explain it. So what you're basically saying is, just to referencing the Straits Times Index,
Yes.
the STI scenario is that you may have a certain position in STI or DBS, whether it's a long-term position, for example, but and the markets drops and you have a short-term view on perhaps that it might drop a little bit more, and you can actually capture that short-term view, that profit that materialize if it does indeed go down, without giving up your long-term position as well.
Yes.
And that at a very low cost as well.
Yes, because price will always move up, down, up, down. If you know the price movement, even generally it is heading up. But what do you do when it's coming down? As a professional trader, I can't be sitting there and then doing nothing.
Yeah.
So there could be something I could just do it. Of course, I have to weigh my risk and reward. So, for example, warrants is something where the risk is kept. I'm able to know that this is the maximum loss I'm going to have.
It gives you another alternative to actually trade the market, even when you want to hold on to your long-term position.
Yes.
Warrants appears to be something that's more for short-term trading. Is that true? And
Yes.
do long-term investors, can they use warrant in any way to build their portfolio?
Warrants is listed in SGX and usually it's about 6 to 10 months. So you don't have ones at 6 to 10 years, 6 to 10 months. But for long-term investors, I explained already, it's good as a hedge. So for example, if you think that there is a event coming up, let's say earnings, and as I said, you don't want to sell the stocks, then you can use it as a hedge to temporarily buy a put warrant. So that if your stocks drops, then you are able to profit from that. So it's like a protective instrument, for warrants.
Warrants appears like, it's a leverage instrument, so the potential for high returns is there. But we all know that high returns usually always comes with high risk as well. So what are some of the risks of trading warrants that an investor should be mindful about?
It's a double-edged thing. When you are talking about amplified return, that means you have amplified losses as well. So if you are able to make for example, if DBS move up by 5%, a warrant can move up by average maybe 30% to 50% in the same period of time. However, this also means that if you're in the wrong direction, then you might be losing 30 to 50%. So this is one risk. You don't over leverage. That means you buy within your own means. Of course, warrants, just as I said, has an expiry date of 6 to 10 months usually. So you don't hold the warrants for a long period of time. Because as you keep holding the warrants, there is this component which is called time decay. As you hold towards expiry, and at the last day of expiry, your warrants can become worthless. So it is meant to be where you think that there's an event going on, or technically you look at a chart, it's going to do a breakout, and you're going to tap into that short-term trading opportunity. So very important, there is this expiry date and there's this time decay. So as far as what I see as these are the two main risks involved in warrants. As long as you know that you don't over leverage, you don't hold to expiry, and it's a short term, and that is how a trader can make use of warrants, especially for retail traders or retail investors, because it helps to build their portfolio.
Okay, so be wary of the time decay risk, leverage as well, and obviously the position can go for you or against you as well. And just to add, so with warrants, there's no margin call, or the greatest loss you can suffer is your principal invested. Is that correct?
Yes. So it's different from contract for difference. Warrants doesn't have a margin call. It doesn't want margin. It takes cash from your account, and whatever that you spend
is the
to
maximum
buy is
you
the
can
maximum
lose.
loss. Yes.
There are also other leverage tools that I know that's available in the market. So for example, we have daily leverage certificate, DLCs, as well as contract for differences, CFDs. How different is warrants from these two products, DLCs and CFDs?
CFDs is a margin product.
Okay, margin product.
Is a margin product, which means that you use 10% or 20% depending on the margin factor to tap into the opportunity of the underlying. So for example, DPS is $45. You use 10% means that you use essentially 4,500 to buy or tap into opportunities of a 100 units of DPS. So it's a margin product. In other words, you get margin call.
If the position move
You
against
can
you.
get the margin call if it means move against you. Second, you do have financing charges
Okay, financing
because
charges.
you are essentially borrowing money at financing charges. Right. So the longer you hold, the more financing charges that you have to be paid. So that's CFDs. Right. But if you compare this to warrants, you don't have the financing charges, you don't have the margin call. Then if you talk about DLCs, you have 3 times, 5 times, 7 times leverage. But if you're looking at a more leveraged product, then warrants can be 3 times to 30 times leverage.
Okay, so as much as 30 times.
Yes, correct. This is how, if you are really looking at leverage products and you really want to go leverage, then warrants will be with that highly leverage. Apart from this, of course, then you do need to understand all of them, they are all leverage products. In one way or another, there's also a risk of a higher lost because it's a leverage product. But when it comes to CFDs, there is always the liquidity issue.
Okay.
And you don't really have this liquidity issue during normal usual times. But let's say, for example, I remember there was during the 2009 where we have the US-led financial crisis, prices was plunging. So a lot of CFDs traders couldn't exit their position because then the counterparty, because the price was dropping too fast, right? The counterparty couldn't accept their position. But when you talk about listed products in the exchange, then as I mentioned, the warrant issuer has to appoint market maker to provide liquidity. So the traders can always exit their position. So this the liquidity risk is something where it's not well known or well brought up, but something which I experience when I'm trading, and I still remember very clearly. And that's also the reason why I choose certain products and not another product.
Okay, so this liquidity risk typically not an issue most of the time.
Yes.
But in all your black swan event, there might be a risk where you have some issues with exiting your position with products like CFD.
Yes.
The warrants that you buy requires an issuer, right? So it's also fair to say that you probably can't trade all types of indexes and equities using warrants because there must be a warrant available out there on the market. Is that usually a challenge for some traders because they simply don't have the warrant to trade on the products that they want to?
All right. So, for example, traders are looking for products that's interesting to trade. Usually they move because we don't really care about direction. Up or down, as long as it moves, we can make money. What the issuers will also be interested to do is to launch warrants which are interesting to trade for the traders.
Okay.
So it's all a demand and supply thing.
Right.
For example, I know that Macquarie recently issued Mart.
Because it's so popular.
Because it's popular, because everywhere people are talking about Mart, and even my friends who doesn't know anything about trading or investing asking me, can I look at Mart at this moment?
Both the product and the stocks.
So for example, an issuer would have popular instruments. For example, Macquarie, as far as the only issuer in Singapore, they have NASDAQ, they have S&P 500. These are all popular products. They have Singapore listed stocks, popular stocks, Hong Kong listed stocks, Tencent, Meituan, Alibaba.
If you happen to want to trade a stock or index that is super, unpopular or no one is really trading it, then there is a chance that the warrant doesn't really exist for that product yet.
Yes, but again, as I said, for traders,
You want to trade.
you want to trade things that
Are going to move.
interesting. Yes, correct. So usually I would say that they are open and we can just talk to them.
Okay.
Yeah. But anyway, they have products that I'm trading, so I'm fine with that.
Yeah. I know both DLC as well as warrants, they both have this offering where you can't really lose more than the amount you invest in, right? So is that one similarity that I think that a lot of traders will like, because the fear of having that margin call is not really something that that can worry you as a trader sometimes. What are some other differences actually when you look at DLCs and warrants? Are they, because you mentioned also the exposure, the leverage amount, But beyond the leverage amount, are there other things that if I'm a trader that I should think about before I choose which instrument better suit my needs?
Okay, so for DLCs, there's this unique feature which is called airbag.
Airbag mechanism, right?
Yes. Now, what is this airbag? It means that to each instrument, whether it's stocks or whether it's index, there is a certain percentage movement in a day that the DLC's issuer allows. So, for example, if let's say a stocks move down more than 15% in a day, and I happen to be buying that DLCs, that means I'm in a loss, right?
Yeah.
That means I'll be losing more than 15%. So because let's say, for example, a DLCs is 5 times leverage, 5 times 15, it means that your DLC will have dropped by 75%.
Yeah.
Okay. So when the underlying moved down by 15%, for example, the DLC would drop in the value. So there is this airbag stop mechanism that stop the DLCs from trading. So there's a cooling period. And when there's a cooling period, they reset the price of DLCs and there's a new basis price. So the good thing about this is that it stopped if the underlying continue to drop, then the DLCs would not move down that much. However, if the underlying happen to rebound immediately or the next day, then the DLC's price would not follow and move up as much.
Because it's now based on the lower price
Yes,
that
it's
it's
based
tracking.
on the price,
Right? So
yes.
that's kind of like a circuit breaker where they pause it for a while, they reset the base price. So if it recovers, it doesn't recover fully as well.
Yes.
With warrants, it doesn't work
With
that way.
warrants, it doesn't have this issue. So warrants, there's only 2 things you need to remember. One is the gearing. So how many times is that gearing? Which is the same as DLC because each of them are all geared products. Okay, number 2 is that as you buy, there is this time decay component. If you compare the pricings of warrants, they are mostly priced less than 20 cents. As I mentioned, right, a lot of them are in the range of 5 cents or 1 plus cents, 2 cents. But DLCs depends on also the products. You do find some of them more than $1. For example, some could be more than $2 as well.
Okay, so there's also a cost component that we should consider when we are thinking of trading with different kind of instruments as well.
I think that cost is the same because if at $1,000 you could be buying less DLCs. But let's say for example, if you have let's say a trader, right, who only wants to buy let's say $100 worth of let's say trades, then you can't be getting a DLCs because DLCs minimum amount will be also 100 units. So if you have DLCs that's $1, 100 units, that's $100. But if there's DLC of 150, you buy 100 units, that's $150. So you could use that to, warrants, but you can't buy a DLCs.
A last question I would ask is that for anyone who is new to this product of warrants, what is one advice that you would share with the viewers before they think of trading it?
I want to emphasize the risk involved. So these are derivative, these are leverage products, hence the risk is much, much higher. So anyone who are interested to do whether warrants or options or DLCs or any derivative products, they must really understand what they are in it. That means that get educated, go to the issuer website. They have usually a lot of resources to educate. I mean, exchange, because I'm training for SGX, also the exchange trainer. So we do provide a lot of training to train anyone who are interested in the product. Okay, so understand how to use, understand the risk involved. But what I think is very important is that volatility will stay. So as a trader, we should be having all these products at the top of the mind. Meaning that, if there could be a correction, I won't say a crash, but a correction, rather than to pause and to freeze, then at least that there is something which we can do about and to know this product inside out. Say for example, if one day the market is going to crash, right, Timothy, what would you do? Oh yeah, let me just take a look at warrants, take a look at this product, take a look at that product, and try to hedge our portfolio because remaining invested is a must. I also have a basket of investment, but I do maintain another basket which allows me to trade in and out to tap into that volatility. So I guess that maybe 2 things. One is to get educated. Second is really to have that mindset and not to reject having these instruments as part of the assortment.
It's really about having the different tools at your disposal so that you can be prepared for the market, both in terms of the long term as well as in the short term. Thank you, Binni, for sharing your thoughts with us on the Dollars and Sense podcast. If you're listening or watching this episode, we hope this discussion on warrants has been useful for you as an investor or trader. And if you like our content, don't forget to follow us by subscribing to us on the Dollars and Sense podcast. Whether you're watching or listening to this on YouTube, Spotify, or Facebook, leave us your thoughts on the comment section wherever you are listening or watching this.